Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. What a crazy week! We got the big US inflation surprise. April CPI came out at 4.2% year on year. That's the highest since 2008. Yet, 1/3 of the increase was due to a massive increase in used car prices. So there's enough in the report for both inflationistas and deflationistas. US bond yields tried to stay above 1.7% on the day of the release, but has since fallen back. Stocks sold off on news, but like bonds, they've also reversed since then. And what about the great inflation hedge hope? Bitcoin, it has been tanking. I asked today's podcast guest, Dominique, to give her updated view on the Fed after this inflation print, which you can find on the Macro Hive site. You can access this piece by becoming a member at macrohive.com. This also gives you access to our archive of research notes and to our member Slack room where the Macro Hive team and members discuss markets all hours of the day. It's refreshingly different from Twitter. And when you sign up, the first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macro Hive the hidden gem for investors. Once again, sign up at macrohive.com. Now, on to this episode's guest, Dominique Dwor-Frecaut. Dominique is one of my favorite macro thinkers and economists. She's so good, I've hired her to work for Macro Hive. Now, as for her background, she's worked at Bridgewater, Barclays and RBS, and before that, she's worked on policy and research at the New York Fed, the IMF, and the World Bank. So she clearly has the credentials. We had a great chat, and I should add that we did record this before the big April CPI upside surprise, though it wouldn't change our conversation or her thesis. Now on to our conversation. Welcome, Dominique, to the podcast. It's great to have you back, and I always enjoy speaking to you. I mean, I have the luxury of being able to speak to you quite regularly now that you're kind of in the Macro Hive family. So welcome. Now, the first thing I actually wanted to ask you, and I didn't ask this the last time you came on our podcast a year ago, was what is your origin story? Where did you go to university? When you were at university, did you think you were going to enter the finance world, and how do you end up where you are today?
So first of all, thank you for having me again. Really looking forward to that conversation. My origin story is a bit random, really. I went to school in Paris in one of those grandes écoles where, to be perfectly honest, I was a bit bored. It was called Sciences Po. I did economics there, but I never saw a single equation in my 3 years there. I wanted to go abroad. A friend of mine said, oh, there is this place in London called the London School of Economics. I hear they have a good program. Why don't you apply? I did. I got in. I did my MSc straight after my undergraduate. So when my professor suggested a PhD, I didn't think much about it. I just did it because it was there. And in my last year of PhD, the IMF showed up for their annual recruitment mission. And a friend of mine, I wasn't there actually for their presentation. A friend of mine made an appointment for me, and I was asked to go to Paris for further interviews and so on and so forth. I ended up in Washington, D.C. The IMF was a little too structured and too culturally conservative for me. So I did something which is called crossing the street, because the IMF and the World Bank in Washington, D.C. are on opposite side of 19th Street. So I crossed the street. Then at the World Bank, I ended up working on East Asia and being the lone voice predicting the crisis. I was a country economist for Thailand, predicting the 1997 crisis.
Oh, country economist for Thailand. That's interesting. Because obviously Thailand sort of kicked it off. Well, kind of was a spark during the Asia crisis, I suppose.
In fact, I remember very well I was writing a paper with an economist from the Bank of Thailand, who is now one of the most famous economists in Thailand, Kopsak Putrakul. And the day the Thais devalued, I walked into my office at the World Bank, and there was an email from him saying, we have devalued, we need to restructure our paper. So actually, I was a little bit the lone voice in the wilderness when I was highlighting the risk of crisis. That convinced me that maybe the private sector was a better environment. And that's how I ended up in Singapore with Barclays, and then came back to the US for personal reasons. So I wouldn't say, that I had charted the course of my career from day one. I think it's more a combination of interests and opportunities.
Okay, yeah. And then at Barclays, you did research on the sell side for a while, and then you also spent some time on the buy side as well, working for Bridgewater.
So when I got back to the US, my first job ever working for a private financial sector employer in the US was Bridgewater. And after that, I worked at a couple of macro startups and the New York Fed. And here I am, Bilal, absolutely delighted to be working for you. You're such a great boss, keeping me on the straight and narrow and being supportive in every possible way. So I'd said it was not a straight line, my career, but it ended in a good place.
Absolutely, yeah, and quite a varied range of experiences, which no doubt explains why you're so good at your job. Okay, so let's kind of jump into some of the sort of macro themes that you've been looking at. Perhaps we can start with your view on the US growth profile for this year, where you actually have, I would say, a bit of a non-consensus view. And the consensus view is that we're going to see fairly rapid growth in the early part of this year. So currently Q2, Q3, very high growth. And let's just talk about the US as kind of the proxy for everybody else. And then growth will start to subside Q4 as we go into next year. And this is all sort of premised around kind of a reopening argument that we're kind of seeing the reopening now. And then after you see the big reopening sort of rush, then things will ease up. But you have a view that the growth profile is actually going to look somewhat different from that. So can you kind of lay out your case?
Sure. The case is basically about labor supply. I think for the longest period of time, I was one of the V-shapers out there. And what made me change my mind and think that growth was going to be delayed is all the macro data and the anecdotal data showing that firms were not able to find workers. So the data, you can see it in the JOLTS. If you look at the UV, the unemployment vacancy curve, or if you look at something which is really striking and has been going on since the crisis, actually in the JOLT data, if you look at the hires relative to the job openings, they are at a historical low. They were low by historical standard before the pandemic, but now they are even lower. And then just walking around, I've seen the signs for hire multiply. They are even. I was in Portland.
And just for clarity, you're based in California in the US.
I'm based in California. So I was in Portland, in Oregon, a couple of weeks ago. There were restaurants with signs saying we'll pay $1,000 bonus to any cook who wants to sign up with us. So, we as economists, when we are trained, we are taught to think that the supply side always follows the demand side and, ignores the supply side. But it struck me that if we don't have the supply, if we just don't have the people willing to work, well, the supply side is just going to be a constraint.
And why aren't people filling those roles? Because the unemployment rate is still very high. And if there's all these openings, why aren't people going to work? Presumably it must be to do with COVID in some way.
So I think it's again, looking at the data, it's a combination of things. If you look at the participation data, it was 20 basis point in April, 20 basis point increase, but 30 basis point for men and no increase for women. And 30 basis point is really at the upper end of the range for participation changes. And so the difference in men and women participation made me think that it's really the lack of school openings. And again, if you look at the data, if you look at employment in primary and secondary schools, or if you look at employment in children daycare center, or even Oxford University has an index of state school openings in the US, it's very clear that progress is slow. So the combination of that and women not going back to work made me think that, it was a lack of childcare opportunities and lack of places where they could send their children. Now, it doesn't mean that the benefits paid by the Biden administration are not having an impact, for sure. And to be frank, if I was paid minimum wage to do an unpleasant job and the government offered me a replacement ratio of more than 100%, I'd stay home. So it makes sense. So I think it's playing a role, but perhaps not as much.
And just on the female participation issue, I mean, some people have called the COVID recession a recession for women. I mean, is that a fair characterization, or was that kind of missing something as well? I mean, I'm generalizing a bit here.
So for sure, I mean, the collapse in participation has been significantly greater for women than men. And it's because, whether we like it or not, women still assume the traditional role of caretaker in society. I mean, more women are now graduating from college than men. But I mean, what the data suggests is that when someone needs to stay home to look after the kids or look after a parent who is sick, it's typically the woman who does so.
Yeah. And on this school issue, does this also mean that come the summer or after the summer, when the next academic year starts, presumably schools will be reopened by then, so then things will normalize?
Yeah, and that's basically why I expect the growth profile to be more backloaded, that we will see the big pickup after school reopening, so around September, October, and that we will have more of a pickup in growth next year. So I agree with the consensus view. We are going back to trend about 2%, but I think it's going to happen more at the end of this year and next year than right now.
And just another question on the school reopening and this participation rate issue. I mean, can you look at this by state? So, for example, Texas and Florida, I assume, are more lax compared to, say, California, where you are. Do you notice a difference there?
Yes, you can map it by state, absolutely. And there is, as you'd expect, there is a difference between the blue and red state, which, by the way, I think is a positive thing, because you have a sort of competition between states to have a more efficient policy response to COVID. So hopefully this competition is going to speed up the reopening, because if you look at the data on immunization in Israel, for instance, or even within Israel, there is no question the Pfizer and the Moderna vaccines work. If you can get a large enough population, share of your population immunized, there is no danger. You can go back to a normal life. And so there is no reason to keep schools closed at this stage. So the competition, I think, is very positive.
And I know you've been looking at COVID and the impact on the economy very closely over the past year. I mean, what are your sort of general thoughts about the red state, blue state way of dealing with this all, in terms of, I mean, the Republican and Democrat states? I mean, what are the general patterns that you've observed in terms of COVID deaths, economic activity? I mean, are there patterns that you've identified?
Oh, absolutely. And it's really interesting, because the pattern in terms of excess death, which is really the more reliable way of looking at the impact of COVID, because it's very hard. You often have comorbidities when someone dies, including COVID, and it's really hard to assign death to a specific morbidity. So I find that excess death relative to historical averages from all causes is probably the more reliable measure of the impact of COVID. And to me, what's absolutely fascinating is that red and blue states have followed very different strategies, with blue states usually much more stringent, more lockdown, more restrictions. But when you look at excess death since the beginning of the pandemic, there is no marked difference. So it seems, and to some extent, I think it reflects the fact that we control much less than we think we do. We don't really understand fully how this disease is transmitted. We also control behavior less than we think. Like, for instance, the US never had a single period of US-wide coordinated hard lockdowns. It's more states that decided to lock down at different times. And because US Constitution says states cannot impede movements of US citizens across states, lockdowns never worked. So we have an institutional setup in the US where the lockdown, in my view, has a lot of negative economic consequences without obvious positive health consequences. So all those things suggest that, red states, in terms of trade-off between health and economic impact, have found better points than blue states.
Yeah, that's very interesting. Yeah, and I think, during the Trump years, at least, I think everything got so politicized with Trump that obscured people's objective analysis of events as they were unfolding. So, this is an example of one of those things. Okay, now if we move back towards macro, the other big debate we're having in markets is obviously on inflation, and I've had many guests on our podcast who are looking for inflation. Many people are saying we're underappreciating inflation risks. They're saying that the Fed view that we're going to have a temporary spike in inflation is incorrect. We're actually going to see a permanent shift up in inflation. What's your view on that?
I'd say that for once, I'm with the Fed on this one, which is not to say that I'm not expecting an increase in inflation, but for different reasons than the consensus. So I agree with the Fed that, the spike in inflation we are seeing are just COVID related, like for instance, this temporary decrease in the supply of labor caused by schools that still have to be reopened. I mean, even chips, it's also a temporary shortage. And to me, when we talk about the big inflation coming, look at the price of the SOX index, which is Philly Fed index of semiconductor firms that buy, sell, or design semiconductor. It's been falling for a month despite the shortage. And why? Because there is this expectation of big increase in capacity investments that's going to bring down the cash flow, but the big increase in capacity investment longer term will prove disinflationary. So I'm with the Fed on the impact of COVID, but longer term, I think inflation is likely to make a comeback for structural reasons. Essentially, I think that since the Volcker recession of the early 1980s, we have moved into a low inflation environment, largely because there has been a structural change in the relative power of workers and producers, that basically workers have lost a lot of market power. So you have a flat Phillips curve. Even when there is no unemployment, wages are not moving much, productivity gains go to producers. While on the other side, of the bargaining power, of the bargaining table, you've had producers who have become more concentrated. So they've gained more market power and they are getting a bigger share of income. As we all know, the share of workers in national income has been declining for decades. And I think this is very disinflationary because the propensity to save out of profits is significantly higher than the propensity to save out of wages. And on top of that, what's happened is that typically in a labor market, the people who are paid more tend to have their pay indexed to profit, while the people who have lower wages tend to have their pay driven by labor market slack. So when you've had this increase in the share of profit in GDP, you've had also this elongation of the scale of wages and greater inequality. And again, people who make more money save more. So when they get a greater share of income, that share of income goes into demand for financial assets rather than demand for goods and services. And I think reaching the end of the political sustainability of this increase in inequalities. And to me, US politics at the moment are absolutely fascinating because what's happened is that in a way, the blue-collar workers have become the swing voters that both the Democrats and the Republicans are trying to because these are the people who will decide, what is the color of the next Congress. And they have different ways for going about it. I'd say the Democrats want to influence the distribution of power very directly with laws that support unionization, collective bargaining. They are also implementing a program of public spending that is more targeting low-income Americans, while Republicans are trying to raise the share of workers by being more protectionist, by bringing more jobs home, and by expanding the overall share of the pie, while restricting the competition from abroad. But the end game is the same. Both parties are trying to redistribute income. And that, I think, could very well revitalize growth and revitalize inflation as well.
And is this your base case? So in some senses, you are saying that we are going to see higher persistent inflation based on this premise then?
Absolutely. But I think it's going to take us a while to get there. Like, for instance, if the Republicans win the midterms election, we're going to have a big fiscal cliff because they will refuse to sign off on another large deficit, just as they did under Obama. So the Republicans holding the Senate will make for tighter fiscal policy than if the Senate remained Democrat.
And was it your sense that, when Trump came into power, he had his fiscal stimulus, which was more kind of tax cuts, and he was more protectionist, at least in terms of sentiment? I mean, did you think that ended up helping blue collar workers? I mean, did it sort of result in this narrowing of inequality?
So yes and no. There is no question that there was a rebound in the workers' share of national income, but I felt it was more cyclical than structural, that we really ended up with tight resource utilization. But the fiscal policy, and in fact, there was a study done by the Congressional Research Service, the fiscal policies of the Trump administration benefited mainly upper income households, the tax cuts. And what those upper income households did is that they raised their savings. So if you look at the trade balance against the budget deficit, you can see clearly that under Trump, the budget deficit widens, but not much happens to the external balance, which, as you know, is the overall savings investment balance, because the tax cuts benefit mainly upper income and household and corporates. And what those did is to increase their savings. So net, there was no increase in overall savings relative to investment, and the external balance as shown by a fairly constant external balance. So that's why, by the way, I think we will take a bit longer to get to that higher inflation environment if we have a red White House or a red Senate than if Senate and White House remain blue. But I think the historical trends are there. I mean, I joke that when I was a student, in France, when in your last year of high school, you have to study philosophy. And at the time, all of the philosophy teachers were Marxist. So I had to sit through, lecture about Marxism, which I thought was fairly boring. But in a way, it's Marx's revenge because it's a capitalist system generating a crisis of excess supply in a way.
Yeah. I mean, I always found Marxist analysis is quite good as a critique of capitalism, but its solutions tend to be quite poor.
Oh, I'm not saying that the solution is to...
What I'm saying is there is some value in the Marxist analysis in terms of, the power dynamics within an economy and the kind of inherent destabilizing force that capitalism brings about.
Oh, great. I wish it could have been said in a more concise way.
Yeah, no, I hear you. And now on this fiscal issue, many people are looking at the fiscal stimulus that we saw last year and actually this year as well in terms of the checks people have been getting. And people are saying that we're in a new paradigm for fiscal. So not just in terms of, that we're seeing a stimulus, but in the nature of fiscal, that we're coming closer to MMT, we're becoming closer to universal basic income. I mean, what do you say to that?
So I say to that one of my favorite podcast besides yours, of course, Reggie Zingales, capitalism, who compared MMT he called MMT the Laffer curve of the left. So, I mean, let's ignore the acronym for a second and think, what is MMT? It's basically the central bank funding the government deficit. In that sense, QE is MMT. I mean, the only reason we are not calling QE MMT is that central bankers are assuring us that, that QE is independent. They are independent. It's only by accident. I think Clarida used the term copacetic, coincidence, or basically they are telling us that MMT is a terrible thing, but you could argue that if you look at the facts, they've been practicing MMT since 2008. No, it seems to me the issue is really with this excess savings that the economy has a tendency to be in a low inflation, low demand equilibrium. For instance, look at capacity utilization indicators. They've been going down since the GFC.
Actually, just a point, you said excess savings. You mean for the US, or are you talking global?
Desired savings. I was thinking, about Keynes' argument about excess savings, that if you want to save a lot, since your consumption is somebody else's demand, if everybody at the same time wants to save a lot, the economy ends up with a fairly low.
But at the same time, the US has a current account deficit, so it has the opposite of excess savings. It has under savings, no? It's a net borrower from the rest of the world.
Definitely. But in relative to the US own trajectory, growth and inflation are lower, and capacity utilization is lower in the US now than 20 years ago. Now, there is no question that compared with other countries, the US has always been the consumer of last resort.
No, understood. Yeah. So in some sense, what we're saying then is that the current account deficit is smaller than otherwise would be if there wasn't this excess desired savings.
Absolutely. And also in terms of current account, you also need to think about the relationship with capital account and the fact that the US has a world currency, has the biggest financial market. So you have this structural positive capital account or financial account, to use modern terminology, that also explains why the US tends to have a negative.
Yeah, it kind of goes back also to Michael Petit's argument about the Anglo economies tend to have very open financial markets and tend to be very open to receiving capital flows from the rest of the world, to the UK, US, and so on. So yeah. Okay, I think I had interrupted you there, but you were saying that the US is in this kind of low growth, low inflation equilibrium, or has been.
And you also had, for the longest period of time, the view that, fiscal policy should not be used for stabilization purposes. I remember when I was at the World Bank and doing program countries, the orthodoxy was that you manage the economy with monetary policy, you use fiscal policy to fund long-term infrastructure plans. So I think you've also had this imbalance in the policy mix between fiscal and monetary, and too much burden placed on monetary policy, the only game in town, to quote Mervyn King. And so that explains how central bankers ended up doing QE, to fund, basically to reflate the economy. And an additional issue, a big issue, which we don't discuss enough, is basically the asymmetry in the mandate between fiscal and monetary policy, that most central banks have an explicit legal mandate to stabilize the economy, while I think no country in the world, maybe one of the Nordic, has a country for the parliament, for elected officials, to use fiscal policy to stabilize the economy. So the result is that by law, central banks have to mop up after politicians, basically. And so they end up having to provide so much stimulus that the only way they can do it is by buying bonds, and those bonds happen to be the government, to be the debt that is funding the government deficit.
Yeah, understood. And so in terms of the specific packages that we've seen from Biden, or Biden/Trump, the first wave were, you could say, kind of emergency fiscal. And now we're talking more about infrastructure. And I know in the US, there's a big debate about the semantics of infrastructure and the fiscal, that is it really infrastructure or not? I mean, what's your sense of at least the proposed packages that Biden has announced? It looks like in total, it'll be close to $4 trillion in terms of the two packages. Presumably some of it will get watered down. But I mean, what's your sense of the implication for the US economy of those packages? I mean, will it be cyclically positive? Will it improve the US's trend and growth? What's your take?
So the easiest part of your question to answer is the one on long-term growth. Anyone who has just, traveled from Manhattan to JFK knows something about the state of US infrastructure. We get the occasional bridge that collapses and it makes the front page of the newspaper, but it's like the tip of the iceberg. The infrastructure in this country is abysmal. Plus, there is an enormous need to improve cybersecurity. As we are seeing, we are getting more and more incidents, at least incidents we know about that get reported by the media that are getting, more and more consequential. So there is an enormous need that would have long-term positive implication. Now, the cycle, I would argue that the administration will get something passed. Essentially, until the midterm, the administration has control of Congress. It can get things passed in the Senate with a simple majority through reconciliation. Apparently, it can use the Senate parliamentarian, that is a career official who decides on what is conform and not conform with Senate laws and procedures, has established that the Democrats could use reconciliation as often as they wanted. So they will get something passed. They will get the centrist Democratic senators to support something. The bottom line is that, in my view, the race to keep the majority in the midterm started the day after or the night of the Georgia elections, senatorial elections. And so we are not going to have a fiscal cliff next year, whether it's, the normal run-of-the-mill budget or whether it's infrastructure expenditures. The administration will make sure, the administration and Congress, because the Democrats want to keep Congress, they will make sure that, especially if the pace of the recovery this year is disappointing, they will make sure that there is no fiscal cliff.
At the same time, we could, if we look at the fiscal impulse, presumably that would be negative next year, given how large the fiscal stimulus was this year. It will be a smaller fiscal stimulus next year. So from a kind of an impulse perspective, you'll end up with a negative fiscal impulse, which could then be a drag on growth, presumably.
Absolutely. But the other side of the coin will be that private demand will pick up. So you'll have rebalancing of the economy away from public sector demand to private sector demand. In fact, as we discussed earlier, the recovery will really be in full swing only in the last quarter of this year and probably in the first half. So you will have a bit of a handover from stimulus to private demand. So I still think we're likely to have growth above trend next year.
And do you have any thoughts on some of the other major economic blocs, so China or the Eurozone?
So the Eurozone, I have been skeptic for the longest period of time. But I think what could be really a game changer is the elections in Germany, because you could have an end to austerity in Germany and in the rest of the Eurozone. If you look at the polls, it's clear that the Greens are on an upward trajectory. Now they are polling higher than the CDU. I think it will be tough to reverse before the elections, because what is happening in German politics, in my view, reflects very deep-rooted weaknesses of the Merkel tenure, and in particular, underinvestment in infrastructure. Again, the fact that there is a digital gap in Germany, it's hard to imagine, but in Germany, one of the difficulties of implementing the COVID response was simply communications between the central Ministry of Health in the federal government, the Länders, and then the private practices, because everybody uses faxes. It's not in the global consciousness, but it's a fact. And you have really a strong duality in Germany between the very large, very modern corporation, Volkswagen, Audi, the corporations we know about, and the Mittelstand, the famous small, mid-size, family-run companies that have not kept up with digitalization. And in general, the infrastructure in Germany is crumbling. Schools, when there was a need to go to internet based schooling. You didn't have the bandwidth, literally. You didn't have the computers. So there was fetishism of the black zero, of the balanced budget, without thinking much about the longer term needs of the economy. And it seems to me that in the short term, it leaves Germany in a precarious position in terms of competitiveness. But in the longer term, it's generated in its own reaction with basically political change that I think is going to usher a rebalancing of the policy mix, again, towards more fiscal. And not only in Germany, but in the rest of the euro area, because the Greens want their own Green Deal, and they are going to support more joint issuance to fund that. And I think it will be very beneficial to the Eurozone because you'll share prosperity, you will weaken the argument of the Euro skeptics. So I think these elections are super important and possibly a game changer. And then, of course, we will have a redistribution of excess savings around the world, which would be a very interesting thing to look at.
Okay, no, I think that makes a lot of sense. And then on China?
So on China, another of my biases, I'm a little pessimistic there. So first of all, the demographics are not great. And I think the demographics make for a very society with a mediocre growth and inflation. Older people save more. So you have this high level of desired savings, which end up making for, weak demand growth. Then you have the financial hangover, which China has been able to postpone the consequences of a breakneck financialization, but you can only do so for so long. Then China has a problem of image with its treatment of the Uyghur and of Hong Kong. And it's a bit of an issue when you are dependent to that extent on global demand. And it's only going to get worse. Plus, the US is making gains in trying to build up coalition against China. And then my concern is that when you have a really authoritarian regime, this regime can get isolated and it becomes a challenge to figure out what is going on the ground. So that if, for instance, you have financial imbalances, you have a dip in growth, you have the beginning of a systemic NPL problem, I'm not sure that given the structure of incentives, that the central government will get all the information it needs to make good decisions from the people on the ground. So these are my biases. I stand to be corrected. I do think that political change in Germany could be very positive for the future of the euro area.
Okay. And, I know that you aren't, kind of a market strategist, but I know you do have a view on bonds. I mean, what's your kind of big picture view on, say, US bonds?
So my big picture view is that there is a good chance we could see a sell-off in the fall, and not so much out of inflation fears, but much more out of rebalancing of the fiscal policy mix. And let me explain why. So if you look at the relationship between bond yields and GDP growth, it tracks quite closely. The two are really well correlated. But if you break that relationship between GDP deflator or say PCE and break-even on the one hand, and real yields and real GDP growth on the other hand, you can see that inflation and break-even track quite closely, obviously because of the contract, the TIPS contract, but that there is a widening gap between real growth and real GDP. And that at present, the gap is widest it's ever been. And in my view, it reflects the fact that markets are probably pricing too much QE, that nominal yields are too low because the market thinks that central bank will do QE for forever. And it seems to me that as the economy recovers, And as we see the impact of the Biden packages, there is going to be a realization that there is less of a need for monetary stimulus, that monetary policy is no longer the only game in town, and there will be fewer purchases of bonds. And this is when we could have nominal and real yields move up quite a bit. And I would argue that, Secretary Yellen thinks along those lines, when she said last week that, with the fiscal stimulus, at some point, there might be a need to normalize monetary policy. I think she very much had this framework that stabilizing the economy is done through both fiscal and monetary. And if fiscal becomes more active, you have less of a need for monetary. So that could be a bit disruptive.
Yeah, no, that makes a lot of sense. I mean, certainly real yields just look just incredibly low right now. So, I'm kind of sympathetic to your argument. Well, now I think it's time for us to go back to the personal. And one thing I like to ask my guests is how they manage, or how you manage, your information and research flow. It's quite easy to be overwhelmed. And what's your kind of routine to stay on top of things?
So my routine is to get up very early. Since I live in LA, if I want to catch up the New York data releases, I need to be up before 5. So what do? I read the news, mainly the Wall Street Journal. I have a look at Bloomberg. I look at our chats. The Macro Hive chats are fantastic. And I think any investor would find it really valuable to have access to that collective expertise. So I look at the chats. I have one website which I look at, which is a little slanted politically, but they often have interesting takes on things. It's called Naked Capitalism. So there you are. I've full disclosure. And I often have, I read the news with a filter. Through talking to our colleagues, I get a sense of, what is important at the moment. And whenever I come across something, I think, okay, bottom line, does it make me change my belief about the world? Like, for instance, what made me take this view on the NFP was reading articles in the newspaper about how businesses really could not find workers and that they had never seen.
Just for the benefit of our listeners, Dominique was very bearish on the last labour market report. She was looking for a very low payrolls number based partly on the labour supply issue. And the consensus, I think, was looking for a very high number, for almost like 1 million. And it turned out to be much lower, closer to 250.
So I walk a lot. So I read a lot. I try to see what people are thinking. I walk a lot because I run also, and that's where I digest things. So I avoid Twitter. I sometimes go on Twitter to look for confirmation of things I cannot find in the mainstream medias, but I have a low confidence on Twitter. So it's definitely not my go-to place. I go there sometimes to find free posts by people who have paywalls on their research, but I'm not much of a Twitter person. Yeah, so it's more about time management than finding the secret source that's going to give me an edge.
No, that sounds really good. And then finally, I love books. And so I always like to ask guests about books as well. So is there any book or books that have really influenced you, either personally or your work over your career?
So short term, I loved the John Kay, Mervyn King book on uncertainty. I've been a follower of John Kay for many years because his philosophy, about the market economy being a laboratory for experiments, and his sort of a deep skepticism of grand theories that explain everything. It really very much fits with my view of the world. I guess I love the book because they describe to me my way of thinking much better than I had perceived it. So that's more of a recent read. Medium term, probably the book that influenced me most, or like most, was it's a book by a biologist. It's called The Social Conquest of Earth by Edward Wilson. And this is basically a guy who was along with Richard Dawkins, a big proponent of the selfish gene, the idea that, and he changed. And I thought it was fantastic because he changed. He's in his 80s or 90s, but he's now thinking of selection more at the group level. So he thinks that as individual, we survive better in groups than on our own. But within a group, if you are a freeloader, you do better than other people in that group. And I thought it was really cool description of a lot of social dynamics. So there we are. I also have this, desire, yearning for the grand theory of everything. So it's a little bit my grand theory of everything. And also what I liked about the book is that it made me think of human beings as just, one example of a living thing among many, and perhaps become more aware that our species has appropriated so many natural resources and, crowded out everybody else, which I think is a big ethical dilemma. So I love that book on many.
Okay, I haven't read that book, but I know the author, E.O. Wilson, and so I will read that book now.
It's short, much shorter than the K. King book. If I have everything, any criticism of that book is that it's a bit of the long side, but really worth it. I really learned a lot.
Great. Okay, that's it. That's excellent. It was a great, wide-ranging conversation with you as usual. And if people wanted to follow your thinking and your work, where's the best place they can see it?
No question. Macro Hive. Macro Hive is a great place to get a lot of inputs on different things from different perspectives. And that's also where you find my stuff.
Great. Excellent. So with that, thanks a lot, Dominique. It's great having you on. And we'll see how the rest of the year, whether it unfolds as you expect.
Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment. Let other people know about the show. We'd be really grateful. Also, sign up to become a member of Macro Hive at macrohive.com. We'll be back soon, so tune in then.